Hey, Steve Saretsky here. Welcome back to the show. Quite a bit to touch on this week. We had an update, of course, from the Bank of Canada. We're going to unpack some of the commentary from Tiff Macklem. We had some mortgage delinquency data. Going to digest that, tell you what to look for here moving forward. We have business insolvency data. We've got household debt servicing numbers coming out. You got all of this data to sort of unpack, walk through, going to give you an update on what's happening, boots on the ground in the Vancouver real estate market for those that are paying attention. But of course, we have to start off this week's conversation with Tiff Macklem, right? Everybody in the industry getting all excited, rate cuts coming. I think we saw the market trying to sort of front run that at the very start of this year. Oh, okay, rate cuts are coming. And of course, we know that the economic data, it hasn't yet been bad enough, right? It hasn't yet been bad enough to drag CPI low enough to get Tiff Macklem to relent and actually cut rates. And so the main takeaway from the press conference, which is, the Bank of Canada holding rates, right? They held rates. The main takeaway was that Tiff Macklem really pushed back on premature rate cuts, right? I think every reporter in the room asked him, okay, when are you going to cut? When are you going to cut? When are you going to cut? It seems like there's a lot of people sitting on variable mortgages or mortgage renewals coming up in the very, very near future and trying to get the Bank of Canada cut. And so, again, you look at financial markets, they're still pricing in the probability of the first cut coming from the BOC not until June, okay? So June. So in terms of the spring market, it doesn't look like it's going to get that lift from the Bank of Canada cutting rates early because Tiff Macklem really pushing back on trying to get core inflation. Core inflation, yes, we know CPI is back under 3, but core inflation remains sticky in the mid-3s. And so let's clip into Tiff's comments right here.
Hi, Governor. I'm wondering how much shelter price inflation is playing a role in your decision to continue holding your policy rate.
Look, housing's a big part of the economy. It's certainly something that Canadians are very focused on. And so, yes, shelter price inflation, it's the biggest contributor to inflation right now. It's certainly weighing on our decisions. Having said that, our target is for total CPI inflation. And if you look beyond shelter, we are seeing that underlying inflationary pressures persist. And one way to look at that is if you look at our preferred measures of core, CPI trim, CPI median, those exclude the things that are going up the most and the things that are going down the most. So most of the shelter components are in the things that are going up the most. So they're excluded from those core measures. Those core measures are still running over 3%, around between 3 and 3.5%, and that's true on a 12-month basis and on a 3-month basis. So what's that telling you is that, yes, shelter is the biggest single contributor to inflation, and it's certainly impacting Canadians. But there are other underlying inflationary pressures beyond shelter. And we're looking at everything together, and I think we've been quite clear. We're looking for further evidence of sustained downward trend in underlying inflation.
So Tiff Macklem's looking at core inflation. You can debate the merits of if this is a lagging indicator or not, but I think we really have to unpack some of the economic data that sort of hit us this week after the Bank of Canada came out, which was first and foremost Canadian business insolvencies, running now at the highest levels that we've seen since 2006, right? Just leading up to the global financial crisis, of course. So Canadian business insolvencies are surging. And this, of course, is before CRA has really started to collect repayment on CEBA loans that were basically the interest-free loans that they were giving out to businesses during the pandemic. Of course, they had to start being repaid in January of this year. But to our knowledge is that they have not yet actually started collecting and picking up the phone and demanding payment. So you start to wonder, okay, well, hold on a minute. If business insolvencies are running this high and we still got a lot of loans to be repaid back, could this scenario get a lot worse? And I think this is the reality of, listen, we started raising rates 2 years ago, basically to the date. It's been 2 years. So you're starting to see the poison is setting in, at least it is for Canadian businesses. If you look at what's happening with the mortgage delinquency numbers, we had the big headline from Equifax this week talking about mortgage delinquencies surging, right? And that was taking up all the news headlines. They're up 135% year over year in Ontario, 62% in BC. But, we have to unpack that a little bit further, right? It's one thing to look at the headline when you have to have some context underneath that. There's about 5 million residential mortgages in Canada, 5 million residential mortgages in Canada. About 10,000 of them are delinquent, okay? 10,000 of 5 million is still a very, very low number. The national arrears rate sits at 0.18%, just coming off of all-time record lows. So the rate of change is dramatic, okay? The rate of change is coming off of all-time record lows. And so you're now starting to see, okay, yeah, rates are up 500 basis points. The poison's starting to sink in. It takes time for people to sort of go delinquent on their mortgages. You're seeing that rate of change start to increase, but it's, again, coming off a very, very low base. So I can give you a stat. This is a fact, is mortgage arrears can double. They can double from here, and they would just be getting back to their long-term averages. So Canadian delinquencies, while it does make a great headline, are still very, very low on an absolute basis. But again, it's the rate of change. You can see the narrative starting to change. Consumer business insolvencies rising, mortgage delinquencies rising. The household debt service ratio in Canada is now at all-time highs. Okay, the proportion of your income going towards servicing debt payments is at all-time highs. So again, people are clearly having to pull back. I know we've talked about last week's video that real GDP per capita has been contracting for 6 consecutive quarters in this country, right? So if it doesn't feel that great, it's because it isn't. It is, the data is showing you that, you are really in this balance sheet recession. We've talked about it quite a bit on the Loonie Hour podcast. Again, highly encourage you to go check that out if you haven't tuned into that, where we go a little bit more in depth on some of these topics. But this is what's happening, right? If you look at all these things, it's not, we had the jobs numbers coming out today. You have the Chrystia Freeland, the finance minister, tweeting, "Oh my God, we added all these jobs again here in February." But if you actually, again, you lift the hood up and you kind of look underneath and say, okay, well, in another month where the unemployment rate actually ticks higher despite you adding jobs, because you're not actually adding enough jobs for the rate of population growth. And that's exactly what the data shows us in this week's labor market report, is that we're adding more people than we are jobs. In fact, the employment number grew by 41,000, but the population grew by 83,000. And so, again, things just aren't quite what they seem. And I think that we're finally starting to see this come to fruition. Again, it does, monetary policy works on a lag, and we're now 2 years into this rate hiking cycle. And we're starting to see it filter through. So I know everyone's talking no cuts. But I do think the economic data is going to continue to deteriorate here moving forward from the BOC. It'd be kind of ironic, right? Because I think what we're seeing now is we're still in a housing market that is really it's still kind of undersupplied. And if there's anyone that's in the market looking for product, they'll tell you the exact same thing. There's not a lot for sale. Most of the stuff that's for sale is complete garbage. Anything that's half decent comes on, you price it fair, it moves, and a lot of times it's moving in multiple offers. And that's really just what we're seeing in Vancouver. It's kind of this segmented market. It just depends where you're selling. You've got record levels of unaffordability. So any price point that is affordable, right? So I'll give you the numbers. It depends on the area and location you are, right? Are you in Vancouver? Or are you in a suburb in Langley? Or are you in a suburb in Abbotsford? So all those markets have these sweet spots where what is the entry level for that market? So for example, give you the numbers in the city of Vancouver here where I work, which is if you've got a 1-bedroom condo, like your entry level is basically like anything under, call it 700,000. Okay, if you've got anything under 700,000 a day, it's hot. You're probably going into multiple offers. If you've got a, townhouse under 1.5 million, it's going to be hot. A 3-bedroom townhouse. If you've got an entry level detached house under $2 million, you're going to be competing in multiple offers. And then you get into these other price brackets as you start to climb up, right? At $900,000 1-bedroom condo at a 5% mortgage rate, the numbers just don't work, and the market demand completely drops off. And so this is kind of the market that we're dealing with, is just a lack of affordability. What can people qualify for? And those segments remain undersupplied. And it's interesting that if you look at the actual data that's coming out. So we look up for the month of February, right? You can see sales still running below their long-term averages. So the demand is still underlying. It's still relatively quite weak. But the listing side is a real problem, particularly in the single family. So look at the single family new listings inventory. It's well below the long-term averages for the month of February, and this has been an ongoing trend. So you're well below average for new listings for a single family detached. And then if you look at the condo market, you're well above long-term averages. And I think what's happening here is that ultimately you're seeing the ongoing weakness in demand from investors. So the investors aren't actively out there buying. The cash flow numbers no longer work. Tenancy laws continue to deteriorate and get worse and worse for the landlord. So that segment of the market is out. They're out of the market. And in fact, I would say are probably net sellers. And that's where you're seeing that increase in new listings, which I think is still putting some pressure on the condo market. And it's really the flip side on the single family market, because who's transacting today, right? You're like, well, who's transacting? The economy doesn't look that great. Mortgage rates are still pretty high in the 5s. Who's transacting? It's people that want to transact. And these are young families that are looking for more space. They need more space, right? One kid, second on the way, or kids are growing up, getting into their teens. They need that bigger space, more separation. They have to transact. And that's where you're still seeing that demand, is for that end user product, particularly in the single family market, where you're really not adding net new supply either, right? Like you're not going out and building new suburbs of swaths of land for single family houses in anywhere in the lower mainland. That product type continues to shrink. So there's still a significant underlying demand for that product type. So that's kind of what's happening in general. I'm going to wait and see the Bank of Canada. Again, market's expecting the first cut to come in June. I think that's pretty accurate. And it would be kind of ironic if we finally got the inventory coming as the Bank of Canada started cutting. You hear you do hear some sellers saying, well, rates are still high. Don't know if I really want to list. Am I going to get the price that I want? Maybe I should wait till rates get cut, the market picks back up, then I'll put my property on the market. So it would be kind of ironic that of all of this, that once the Bank of Canada finally starts cutting rates, you actually get the dumping of supply. I mean, it would be rather ironic if that happened. And I think that's a real possibility. I think it's something worth keeping an eye on. So right now, the name of the game continues to be overall a market that is just really not oversupplied. It's keeping the prices relatively sticky. And so it's a waiting game with the BOC. We'll continue to keep our eyes on that. But that's kind of what I'm keeping an eye on this week. As always, we'll see you next week.